Okay, good morning and welcome back everyone to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we have a lot to share with you this morning as markets are still holding on to some major support levels going into the election after the debate yesterday. So let's take a look at where we currently stand and what our expectations are going into the week before the election. Let's go ahead and get started. Now, before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we're going to start off as we normally do with a general market update in terms of the major indices and where they currently sit. And as you will see that most of the major markets are actually trading in a very similar fashion. So there's certain opportunities there. And then when we look at the fixed income and commodity markets, they are also pointing to what we believe is a fairly constructive market for continuation of markets to continue moving higher, certainly pointing us to more of a risk on environment, meaning riskier assets are getting purchased. Riskless assets or safety assets, if you will, are being sold. So this supports our broader bullish view here in the broader markets. Then I want to take a look at some of the economic indicators and the number of COVID cases that we are starting to see rise in, where we're seeing rise in, what that means for some of the economic indicators that we're currently taking a look at. And then today what we're going to do is a full sector review of all 11 sectors, where they currently sit and what opportunities we see within the individual sectors, and then share with you a few of our ideas before we open this up for questions here at the end if we have a few minutes. So let's go ahead and get started. But the primary question that I think that is on many investors' mindsets at the moment going into the election is really, can the markets continue to hold on to these major support levels that have predominantly held here for the past week or so going into next week, and then potentially have the election as the catalyst that drives or propels the markets higher here. So that's what we want to take a look at. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my charts, my economic research, and the ideas that we currently have in the markets based on our research. So we'll start off with the broader markets. So we have been looking at the NASDAQ 100 or the QQQ for quite some time. The QQQ has broken out above that 282 level, which is a major resistance level since the September sell-off. We've come back to retest that level as support. We have spent multiple days just hovering above that level. And yesterday we had a fairly sizable move to the downside in the morning, but traded all the way back up into the above that level in the afternoon. And our expectation for now is for these levels to hold, at least revisit that 290 to 297 highs or so to the upside and retest that this week, or rather next week. That's our current view here for the NASDAQ 100 index. Now, if you look at most of the major indices, we sit pretty much at the same level. The S&P sitting above that 342 level, which is the same resistance level that it broke out from, came back to retest that as support, and looks like it can continue moving higher and retest back to that 354 level here to the upside that it put in just last week. So both S&P and NASDAQ very similar in terms of performance here at the moment. But if we look at some of the other markets like small caps has actually been fairly strong. And this is constructive of equity markets to continue moving higher. When small caps can keep up with the major mega cap indices, this is generally speaking supportive of the rally that we're currently seeing. Small caps broke out above that 160 level, came back to retest that level as support, and has actually bounced off fairly strongly off that 160 support level, suggesting that small caps has the legs to continue potentially rallying, as we see money flow remains fairly strong here on small caps. So this is fairly constructive, again, of equity markets holding these major support levels. Not only did small caps hold this, but relative the equal weight S&P 500 index is actually outperforming the market cap weighted index. So this is again more evidence that the rally that we're currently seeing and the support levels that are being held are fairly constructive, not just by a few big names dragging the major indices higher. We have broader support now, much larger, broader support of more stocks in the markets that are rallying. And this is, again, supportive of this bullish view that we have that these support levels will hold going into the election. And that's a fairly strong, in my opinion, evidence that we have an evidence of a continuation higher here for equities. One thing I do want to point out here is we've had a major break to the downside on TLT, 20-year Treasury bonds. This speaks to the market's expectation of further stimulus. We were seeing risk safety assets such as treasuries, especially longer dated treasuries, being sold off as a result of it. So investors not seeking safety. We've seen 10-year yields rise above 80 basis points earlier this week. That was a major line in the sand. This certainly puts TLT in a much more bearish state here. So not a lot of demand for these safety assets, not a lot of demand for returns from government bonds. And on the flip side, we have continued to see stability in high yield. So meaning riskier fixed income products are still being purchased. So this speaks to the fixed income market's view that they are taking on more risk with these higher yield products and selling off the lower yield treasury bonds. So this speaks to more of the fixed income markets, providing some evidence that there are flows into riskier assets, which again is generally supportive of equity markets to continue rallying from where we currently sit. When we look at copper futures, this is where, again, copper futures provides us with a good real-time indicator of industrial demand or demand for industrial goods. Now, when the economy is booming, you generally tend to see industrial metals like copper rally with these types of moves. So when we have copper futures making new all-time highs, and this is something that we've seen for quite a while, where it's made new highs multiple times and it continues to make new highs. This is again supportive of just the broader economic recovery that we're seeing, not just here in the US, but globally. Copper futures very heavily tied to China and the recovery that we're seeing over there. So this is supportive of some of the industrial names like Caterpillar and Deere, some of the names that I've really liked over the past couple of days, even some of the railroad stocks, highly correlated to these types of industrial metals. So overall, when you couple the equity markets sitting at the support levels, the fixed income markets providing some evidence of risk on environment, and then you look at commodities like industrial metals, these are the signs that we typically look for to support the current bullish views that we have here for overall equities. When we look at volatility indices still remain fairly elevated. Now, this speaks to the investors' concern regarding the election, and we're still seeing a fair amount of put buying in some of the index options, so NDX, SPX, put buying by some institutional investors, concern about some volatility post the election. But from a retail perspective, we still see a lot of bullish flow into single stock names, buying call options going into the election. So investors are positioning for further upside, but at the same time buying a little bit of protection so that if there is some volatility going into the election, that they are protected to the downside. So this is really one of the things that we are looking at in terms of, how do you take advantage of this? So you can still look at selling premium, and that's still some of the opportunities that we see, but we're also taking a look at buying some premium here as well, because the election is going to bring some volatility, and there are some opportunities to buy some volatility, buy some upside or downside, and we'll share with you some of those ideas that we are exploring, that including our daily play here from today. One thing I did want to point out here is we do talk about the VIX3M to the VIX ratio. So the 3-month VIX to the 1-month VIX or front month VIX ratio is sitting just above 1. We generally use a break below 1 as an indicator of time to buy protection. Right now, markets do not seem stressed at all. So 1 is usually a good support level that is used as a contrarian indicator to go long equities. So this is really where markets currently sit right now, back at this 1 level. So this is, again, an indicator from volatility that is telling us that potentially this could be an opportunity to go long. Now, there is a caveat here due to the election coming up being that is a major catalyst, that is one potential catalyst that could bring this index below 1 and put us in more of a bearish and much more of a risk off environment where we are seeking protection. So I think more, there are plenty of traders on both sides of the market right now. Certain ones seeking protection, concerned that the election or the election is the catalyst that drives more downside in the markets, drives more volatility, and requires hedging into the election. And on the flip side, you have plenty of investors that see this as an opportunity, the current weakness that we've seen after the recent breakout as an opportunity to go long, especially if the belief that investors that may have different views as far as what the outcome of the election are going to be and what that means in terms of stimulus. I do think that regardless of what the election outcomes are, there is going to be a sizable stimulus bill that's going to be passed. So the markets, from my perspective, are mostly pricing in that stimulus, but also at the same time discounting or putting discounting some of the election volatility that may follow after the election itself. So a lot of angst from investors overall, but I think if you look at everything on balance, I certainly still will point us to the fact that we are holding these major support levels. We've broken out above those major support levels, and both equities, fixed income, and other markets are still pointing us to more of a risk-on environment rather than risk-off. Now, to take a look at some of the economic indicators, this is really where we continue to see a bit of a mixed picture here. The number of hospitalizations in COVID-19 is the one that we pay attention to more than the number of cases, simply because cases, has a lot to do with how much testing there is, and necessarily as healthcare improves, as we get a better understanding as to how to treat COVID-19, the number of cases is less important than the number of deaths and the number of hospitalizations. And that has been on a pretty steady uptick since the beginning of the beginning of October. And since then, we've also seen a bit of a downtick in terms of consumer sentiment. Now, the downtick in consumer sentiment is still well above what we had back in June and July, which is good. However, if this continues to accelerate to the upside, I do expect consumer sentiment perhaps to decline. And consumer sentiment is a very, very key area of the growth and the recovery, the shape of the recovery that we currently have, as retail sales and consumer spending remains fairly resilient, but we clearly see a slowdown in both consumer sentiment and retail sales. Could this acceleration in COVID cases bring this back into contraction territory? Bring retail sales back into contraction territory? That would be, in my opinion, a potential catalyst for markets to weaken a little further. So this is one that we're paying attention to very much. On the flip side, we do have some fairly constructive economic numbers, especially in housing. Housing continues to be one of the strongest areas of our economic recovery. Single family homes continue to have impressive starts in terms of new starts for single family homes. This speaks to the acceleration, if you will, of working from home and people buying homes because they realize that, long term, that working from home is going to be more of a permanent feature. So this has been extremely strong for the housing market. This has been extremely strong for home builders. A lot of, if you look at XHB, the home builders ETF, all of the periphery stocks around that, whether you're talking about furniture stores, Home Depot, home improvement stores, these are all the types of of beneficiaries from this boom that we have in housing. And what we have seen is actually, despite the fact that we've had rising unemployment, you have a record number of small businesses closing, we also have had a record number of business applications that we have never seen in a very long amount of time. So we are seeing, losses in certain areas of the market, but also strong gains in other areas of the market. So fairly mixed economic picture here. And especially if you look at housing data, one of the reasons that housing has been so strong is really due to the low inventory that is available here in housing. And that inventory has actually continued to decline since May. So when you have a market where you have a strong amount of demand for new homes with a lack of inventory, that's what drives this boom that we're currently seeing. And the question is, how long can this boom continue to last for? One of the things that we do look for are mortgage rates. Mortgage rates are a good indicator of demand for a specific for homes. And we have seen a recent uptick in terms of mortgage rates, and we know 10-year rates just got above 80 basis points. So this is potentially a bottom here for mortgage rates. So perhaps this could be, a top or near the top of housing here at the moment. So that is one thing to really pay attention to for those of you that are long the home builders, long any of the housing stocks. Pay attention to the 30-year mortgage rates, because that could signal potentially the top here, if you will, of some of these housing stocks. On the employment side, we do continue to see gains on the employment side in terms of reduction in initial claims, like we saw here earlier this week. We see a decline in terms of the number of unemployed, the percentage of unemployed. But the one thing that I do want to point out here is that despite all of those things, notice how the market hasn't really reacted very strongly to those employment numbers. And from my perspective, that really speaks to more of the number of people who have effectively left the job market, left seeking employment because perhaps they no longer feel that they are capable of finding a job, or maybe they've been trying for the past 4 or 5 months and have basically effectively given up. This is what we saw during the 2008 financial crisis as well. And it was really only until the last couple of years where employment, or the number of people seeking employment, were back to what we would consider pre-global financial crisis levels. So that took almost a decade for that to happen. And we think that this is actually even worse than 2008 financial crisis in terms of the number of unemployed and the number of people leaving the workforce. So this is a big part of digesting some of the economic numbers that we currently see, is how many people have left the workforce. So, that's how we're currently looking at the economic numbers here on the, when we look at economics on the housing side, there is a very mixed picture. And almost every headline number that we see, there's a big caveat behind the scenes. So this is really what I'm trying to help illustrate, is that, the headline numbers so far can sometimes be a little bit misleading. So make sure that if you're looking at these numbers, you're using them as a gauge for the economy, that you understand some of the nuances of these numbers and understand why perhaps the markets did not react very strongly to what looked like very strong initial claims data here this week. So what I want to do is I want to do a full sector review of all 11 sectors where we currently sit, because we haven't done that in a while. And I'll start off here with XLB, which has been one of the strongest recovery names here, sectors here since the March lows here. But that recovery has largely slowed down over the past couple of weeks here, and we've started to see quite a bit of outflow from Chaikin money flow here. So this is one that I'm a little concerned about. We have a bit of weakness. We have this major resistance level. This is one that I'm paying attention to. I really would like to see a breakout here above this $67 level here on XLB for us to continue continue or see this continuation of rotation into materials. But on the flip side, I do think that we're seeing more rotation here into XLI. So between XLB, XLI, we're starting to see XLI industrials start to outperform a little. Industrials actually breaking out above its September highs. There's only one other sector that has broken out above those September highs, and that's consumer discretionary. But industrials broke out above its September highs and is now testing those resistance level as support and can potentially continue to move higher here. So starting to see more rotation here into industrials, and materials is really just keeping pace with the markets, not really outperforming anymore. So between the industrials and materials, industrials looking fairly stronger. When we look at XLC communications, this is really one sector of the market that clearly outperformed the market for quite some time. And then over the past couple of months, since pretty much those September highs, have stemmed its outperformance. So it's not outperforming or underperforming. It's just simply performing on par with the markets. And the question is whether or not this will continue its bullish trend here. Now, with our bullish view here on the markets, we certainly believe that communications will continue to be a strong beneficiary. Netflix earnings did certainly take a bit of a hit here for XLC, but if you look at overall the sector, the telecom companies, the streaming companies, these are still generally speaking better off during this COVID environment than most other companies. So this is one sector that we still believe will resume that bullish trend, even though over the past couple of months, it really has stemmed its outperformance, but can continue its outperformance here over the next couple of weeks. When we take a look at real estate, this is one of the sectors that is a strong underperformer for the broader market. So pretty much since the June highs or so, real estate has made no progress as a market, which means that as the market is moving higher, as this sector moves sideways, it's really underperforming severely as a broader sector. So not only is it underperforming, it recently just broke below the 200-day moving average. This leads me to believe that real estate will continue to be an underperformer and potentially even move lower while the markets continue to move higher or sideways here. So real estate, one of the worst performing sectors in the S&P 500. When we look at financials, this is really where we continue to see this really, really slow rotation into financials. We've seen the rate curve continue to steepen. We have 10-year yields rise above 80 basis points. And this is the very, very slow rotation that we're continuing to see into financials. It's a rotation that's so slow that it's almost hard to measure. But it is there, as XLF did rise higher, more than most of the other sectors after the September sell-off. And if you combine that with the fact that after breaking out above the 200-day moving average, coming back to retest this as support, this could be the catalyst that it needs to start moving higher once you see the rate curve continue to steepen and the 10-year yields rise above 80 basis points. This provides further support here for the major financial institutions. And that's one of the ideas that we actually have here for today, is in the slow rotation that we're starting to see in XLF. XLF was the second worst performing sector in the S&P 500 for quite some time, pretty much since the start of COVID. And we're starting to see financials coming a little bit back to life. It's now the third worst performing sector. So very, very slow rotation starting to form here in financials. When we look at XLY, XLY is one of the few sectors that did manage to break back above those September highs, but notice how it could not sustain those September highs. It is now back to the 21-day moving average, and that could also be a possibility for a bounce off that 21-day moving average. However, the fact that it couldn't hold those September highs, leads me to believe that XLY is a little weaker here. We do see some more I would say, divergence here as XLY made a higher high. Momentum did not confirm that, both on the daily and weekly charts. As it made higher highs, momentum did not confirm those higher highs. That is concerning for the, is this a top here for XLY? XLY has had a very, very substantial runs here since the March lows. Is that rally starting to lose a little bit of steam? That's what we're currently taking a look at here for XLY. When we look at XLP, this is really where consumer staples has become almost a market proxy, meaning it is trading step by step with the broader markets. The initial plunge from the September highs back to retest almost those highs again, and then coming back to test those support levels pretty much in line with the broader markets here. So from my perspective, XLP actually a little stronger than XLY here going into the election, because it is at least performing on par with the markets. XLY starting to see a little bit of underperformance, while XLP starting to see a little bit more outperformance here going into the election. When we look at utilities, this is really one of the major shifts we've seen in performance in one of the sectors. By far, the largest breakout here is in utilities, where utilities managed to break out above this major $62 level here on XLU, and it did it on strong relative strength, almost like acting a little bit like what we've seen from small caps, really just taking off since mid September here, pulling back very slightly and making new highs here past, well past its September highs, well past its recent highs. So when you combine the strong outperformance with the breakouts, this is really one of the sectors that is one to pay attention to. This is one of the biggest rotations that we're currently seeing, is in what was one of the weakest sectors in the market, now turning to one of the strongest sectors in the markets. Can this continue to take off? From my perspective, the fact that it broke out from a multi-month major consolidation area between 58 or so and 60 leads me to believe that there's still a fair amount more upside here into the 68, close to the $70 level here to the upside for utilities. So if you miss this breakout, I still think there's opportunities for further upside, and I would focus on more of the utilities that have more of a green energy tilt to it, more of the renewable energies. Those are the ones that have had the strongest performance, and I think that is what's likely going to drag this sector even higher. And if you look at the specific names that do have those renewable names, those are the ones that have driven a lot of the outperformance here for this particular sector. When we look at energy, we consistently have been getting questions from investors as to whether energy, the decline in energy is over. And for a long time, we have said the answer to that question is no, it is not over. We don't believe that is happening here. But the one thing I will point out here is that we've made a new higher low here. So this was the last low, and now we've made a new higher low. Is that a turnaround here for the sector? If it is, this is a very, very, very early signals of it. I don't necessarily know that that in itself is enough, but if we do manage to break above this let's just call it $32 level, then I would say you have the early warning signs of potentially a bottom here for XLE. That still doesn't mean that this sector won't underperform the broader markets. That is what I still expect, is that it's going to broadly underperform the markets, but you could see a small rally off of this. So pay attention for those of you that were looking for trying to pick a bottom here for energy. This could be potentially the very early warning signs of that. And when we look at technology trading very much on par with the markets, very similar chart to QQQ. You had this 118 level here that it's managed to break out above, came back to retest this as support, and I do expect this to revisit that 124, 125 recent high here to the upside here for XLK. When we look at healthcare has been very strong off the initial March lows, and then just underperformed for multiple months. But it is starting to come back to life just a little bit. So XLV starting to see a little bit of life here. And if we can see a breakout above this 109, 110 level, that would put us into a much more bullish state here for healthcare. And healthcare, starting to see a little bit of gains here for some of the specific names within the sector. So certainly one that we would want to pay attention to. So with that, just to wrap up with a few different ideas, one I wanted to show you is our trade idea for today, which is the daily play. Twilio, cloud-based computing communications company. What I like about this chart setup here is that you have this top here around 290, 294, 295 or so, and you've had this recent breakout here above that level, came back to retest this as support, and what I'm looking for is a continuation higher going into the earnings announcement next week. This is one that from a cloud computing space perspective, from a fundamentals perspective, from a technical perspective, all the things really line up here for a potential trade here. So we're using that as a daily play. As we were showing you before here, we've seen the slow rotation into financials. That's why we like JP Morgan, still best of breed out of the major banks. We've recently started to see some strong inflow into JPM. We're looking for a potential breakout here above the 200-day moving average, so potentially quite a bit of upside here. I would use a debit spread to play for a potential breakout here in X and JPM. And lastly, looking at a name like MasterCard, this is one that has been a strong performer during COVID-19, but we've started to see some outflows in MasterCard. So really, notice how before most of the other names managed to break out to the upside and then hold those levels. MasterCard has not held those levels and started to break out to the downside. So this is one with combination of the outflows that we've seen over the past couple of weeks. This could be one of the names that we could see a little bit more underperformance and perhaps a little bit more outflow out of names here like MasterCard. So opportunities that we see on both sides of the market, bullish and bearish. Again, our focus is more on the bullish side of things. Some of the rotation that we're seeing, that's how we want to play this market, but still plenty of opportunities on both sides of the equation. So with that, thank you so much for taking the time out here this morning. I just want to thank our members for supporting us and allowing us to continue doing this. Just a quick reminder for those of you, if you don't have access to OptionsPlay, you can sign up for a free trial at optionsplay.com, which I'll post into the chat window. And for those of you that are currently on a free trial, membership is just $75 a month or $500 a year. You can sign up using the link here on your screen. And just a quick reminder for those of you, I am out next week, so we are not having a Tuesday and Friday morning session next week or a Thursday afternoon education session, but I will be back the first week of November. So we will have our next Tuesday morning Outlook session, the day of the election. Really excited to be back with you guys to help you navigate, what we're going to see during the election. We will continue to update you on the markets next week through the daily emails that we send out at 11 a.m. So you will still get our market observations. You will still get their trade ideas each day. So thank you so much. Have a great week, and I'll see you guys the first week of November.